Our approach to selecting growth shares is based on systematically screening the entire universe of companies in the UK. We're looking for three key attributes to begin with at the wide end of the funnel. We're looking for three key things, which are one, the ability to deliver above average growth. Two, we want to buy that growth cheaply. So we use a measure called the PEG, which compares the P with the growth rate to give us the comfort that we're buying well. And three, we're looking at cash flow, which is the degree to which profit is converted into cash, and also the degree to which a business generates free cash. Once we've got our shortlist, which typically means about 5% of the entire universe, we knock out 95%. Once we have our shortlist, we're then much more qualitative in our thinking. So we're looking for assurance that growth is going to be reliable and sustained. And ideally, we want businesses which have tangible drivers of earnings growth on a multi-year view. And there's a whole lot of analysis behind that. But that would summarize in essence what we're after. Examples would be, one long-standing holding of ours is a company called Restore Group, which is the second biggest document storage business in the UK. It's a boring business, but it's a very effective business. It's the business. The revenues are kind of annuity revenues. They're very reliable. The business is able to acquire small competitors on a very accretive basis. So it's a very low risk, simple, niche-y business that's very good at doing what it does, and it's been a fantastic investment for us for the last 7-8 years. Great growth businesses, so long as they continue to deliver earnings growth, can really make you a great deal of money. And our experience has been that one should resist very strongly the temptation to grab a profit too quickly. So our experience has been that as long as the earnings growth is continuing, it pays to take a very, very long-term view. And if you don't, you very often want to end up buying the same company back. You might sell it and want to buy it back 2 years later, which doesn't make any sense, because quite often you can't get the shares back or you have to pay a much higher price. So we respect the ability of great companies to deliver both high levels of earnings growth, but also very significant share outperformance. And we don't want to be too clever about timing entry and that kind of thing. If you're lucky enough to get into a good business, you should try and enjoy the ride. The fund's performed well. It's performed pretty well year to date. It's up about 16-17%. The peer group's up about 8%, so it's just over double. Over the longer term, the numbers are even stronger. The fund is in the top 5, 6, 7% of the peer group over 3 and 5 years. Over 7 years, I think we're the second of all the funds in our category. Over 10 years, we're number 1. So over a long period of time, the fund's done well. It's a good strategy. The most significant transaction this year, a series of transactions, has been to exit the house building sector. It's an area we made a lot of money over quite a number of years. The ratings have improved in that time. The businesses are still trading quite well, but our view is the clouds are gathering. We have seen evidence that some of these house building companies are struggling to achieve the headline prices that they're announcing on new houses. And we're also worried by the level of dependence on the Help to Buy scheme operated by the government to encourage first-time buyers. Help to Buy accounts for 35-40% of new house sales, which is a big chunk. It's guaranteed till 2021, but our view is that will be reviewed, certainly in 2021, possibly sooner. We get our ideas from screening the entire UK market. We trawl through looking for the key criteria that matter to us, and then we follow up with very detailed analysis of individual companies. It's a long answer to a simple thing, which is really hard work. The hard work is by far our most important source of ideas. In terms of, I became a fund manager, I think a number of things. As a boy, I liked numbers. As I got a bit older, I was in my teens, I got to like investing. And when I left university, I was looking for a job. I wanted to do something related to investing. I started off as a financial journalist, and investment management seemed a very natural next step. So it's something that's always been of interest to me, and I'm delighted to be doing it. Outside work, I have 3 boys. That takes a lot of time.
And I'm into fishing. I love fishing, and I like also tennis. I've taken up tennis 5 years ago, and that takes a bit of time at the weekends.